You've assembled a very extensive study, Eric. Tell us more about the process that you have used to narrow down the vast universe of hedge funds to just 50 consistent performers. And also, are there any categories of funds that you have included or also left out in your study?
As I mentioned early on, the process of getting the survey underway is by assembling a whole variety of different databases and publications and proprietary sources, and assembling that data in order to see funds that have at least a 5-year minimum return. Because to me, if you look at any shorter period, that just leads to uncertainty. I want to see a manager that generates returns or that extend over a number of years that hopefully include significant variances in the market cycle. Because if you're just dealing with the boom market, that's not necessarily going to tell us much. But if the boom market has some drawdowns, has a bit of a bear mixed in, then you can begin to see how well a hedge fund manager can deal with that. I also want to have $300 million as a minimum in a hedge fund before I would consider it. And the reason is you want to have first-tier service providers. And first-tier service providers are not cheap, whether they're prime brokers, accountants, legal administrators. Having the top flight service providers do a number of things. First and foremost, they help ensure, they don't guarantee, but they help ensure that the integrity of the numbers and all of the data and all of the copy that's being put out is hopefully accurate. And you have a much greater chance that that's the case when you're dealing with first-tier service providers. I also intentionally isolate funds that are sector-specific or strictly commodities or specific country funds from this survey. And the reason is I want to focus only on broad strategies like equity long short, credit long short, distressed global macro. The reason for that is if you're in a specific market, for whether it's commodities, whether it's currencies, or a specific country that might be benefiting from a trend or a specific sector like biotech that might be on the upswing. What a manager does is really going to be dependent upon the headwind or the tailwind that those specific sub-strategies are experiencing. And to me, I want to be able to measure and gauge how well the hedge fund manager is bringing value by the decisions he or she is making. And that's best done is if their strategies are broad to begin with. And that's why I look only at broad strategies. One thing that I will not include in the hedge fund survey is any funds that are exogenously leveraged. That means those that are leveraging the performance of their core fund. And you might see a version of a fund that's 1.5, 2 times, even 3 times levering that core investment portfolio. To me, I want to see what a manager does in his core portfolio without any exogenous leverage. The leverage I'll consider, of course, is anything that's built into the core portfolio, but nothing that's added on gross after the fact, because that's just misleading. It will exaggerate gains and it will exaggerate losses. And the point of this survey is to help find what managers are doing with the kind of investments that they have selected, not how well they can bump up that return through leverage or suffer more drawdown because of that leverage.
I've never heard of a survey that included performance hurdles when writing or researching about hedge funds. Tell us, what hurdles did you use and why?
I also inserted hurdles into the survey, and that was unique. I've never seen a hedge fund survey that actually has done that. And the point of the hurdle was originally instituted in my 2019 survey for the Wall Street Journal, and that tracked performance through 2018, the trailing 5 years. And I set a hurdle of 5% plus 5% for 2018 because the market, as you remember, was down about 5%, and the hedge fund industry was down a bit more than that. So if one could actually generate plus 5% when generally the market was down and when the industry was down, then I think it speaks uniquely about your ability to generate positive gain during a challenging, not an overwhelmingly negative market, but one in which to be able to be on the plus side of the ledger speaks well of the kind of manager you are. And I decided to maintain that 5% hurdle into the 2020 survey, again with the last year being 2019. And that 5% hurdle was very modest considering the market was up more than 31%. And it's not fair, though, to expect other strategies like credit long short, distressed global macro to have performed anywhere near as well as the equity market did in any equity centric investor or manager. So what I did was just demand that a hedge fund produce returns that were several percentage points above the risk-free rate. That didn't seem like a particularly demanding level of accomplishment for that year. And if you're going to be paying hedge fund fees, that's the very least one should expect to generate or to see from an investment. I should add that another element that a hurdle actually accomplishes is in keeping with Warren Buffett's statement, when the tide goes out, you can see who's swimming with shorts. And by having a minimum level of performance when the market goes down is, I think, a simple way of gauging how effectively disconnected a manager is from just following the major components of the S&P 500 and what kind of a distinct return stream they're generating based on their unique investments. Now, what did all these parameters reveal after I crunched all these numbers? And I was, again, very happy to report that looking at the top 50 funds, not only were we seeing a 5-year trailing average that came very close to matching the S&P 500, but they did so with significantly less risk. There was less standard deviation, and there was a much less significant drawdown that these funds collectively had registered compared to the S&P 500. What these 50 funds reflected was a very low correlation to the market. It was only 0.20, and this meant that they generated these very strong returns without connection with the market itself. And that's really the ultimate point of being in a hedge fund, to find a return stream that's uncorrelated to the market and finding you a different way of generating positive absolute return, and certainly with less risk. And that's what makes these consistent performers so compelling.
Is there a sweet spot or a particularly interesting range of AUM that you found when you identified these 50 consistent hedge fund performers?
Another characteristic that my survey revealed, and I've been noticing this year in and year out, is that while you have some very big names who made my list, like Citadel and Renaissance and Element, the vast majority of managers were running under $900 million, and even some were running under $500 million. And this again confirmed to me the merit of looking at smaller managers. And that kind of doesn't surprise, or never did surprise, because you would think that they will have a much easier time moving in and out of a much wider range of investment opportunities than a larger manager would, because a larger manager has to make a more significant investment to move its needle. A smaller manager would have the entire range of investment possibilities from micro to super large cap, and they could look at them whether they're equities or distressed or any other type of asset class in order to move performance. And so investors should pay closer attention to smaller funds because of their unique ability to generate returns across all parts of the market cycle.
Why did you select 5-year annualized returns as your ranking criteria? And tell us also what type of data have you added to that in order to make this survey really relevant for investors?
One of the important qualities of this survey is that it will help investors to distinguish between funds. What I mean specifically is you might see a 5-year annualized return of 12% with a fund whose volatility is very low, where there's a much greater consistency of performance year in and year out. And that will speak of a kind of fund that personally I would prefer, versus a fund that might give you several points greater of annualized return, but you might see much higher volatility that could be significantly more, perhaps 12 or 15 standard deviation annually, and you might see greater drawdown. Now, some investors would prefer taking greater risk, which to me, that's what that kind of fund would reflect, and other investors might prefer giving up some return in order to sleep better at night. So my survey doesn't distinguish between those that are slightly rougher rides versus those that are smoother rides. But the key thing about the survey is that it allows investors to actually see the differences about how a fund might get to a 12% annualized return over 5 years and how one does it when they might see a 15% return over 5 years. And that's a very key distinction of what the survey can provide investors.